it does reflect that institutions are beginning to view this as a legitimate way to store value, because the Bitcoin blockchain is really one of the best ways to record financial transactions with 100% never failed censorship resistance, never fraudulent entry in its entire operation. So, but institutions, only about 5% actually own any Bitcoin, but 95% of Bitcoin has already been mined. It's a fixed supply.
After failing to sustain momentum above $4,700 with $338 million in liquidations, Ethereum fell below $4,300, escalating selling pressure. Tom Lee of Fundstrat popularized a crucial ascending trend line, which the decline broke, indicating that there is a major risk to near-term technical support. $4,300 is identified by analysts as a crucial floor. However, September's historical vulnerability is a major concern. Deeper drawdowns are a real concern because Ether has lost an average of minus 12.5% this month. Long holdings are being methodically flushed, as evidenced by the shrinkage of open interest and negative funding rates, even though it is painful. This liquidation cycle prepares the market for a possible recovery in the event that spot demand returns. Stated differently, the market is self-clearing. Liquidity resets, volatility surges, and weak hands leave. The Ichimoku Cloud and the Relative Strength Index RSI readings are both neutral, indicating that Ethereum's technical foundations are still strong. However, it is impossible to overlook September's psychology. Sell-offs have historically been exacerbated by panic as traders wait for the month's trademark weakness. The combination of this seasonality and structural pressure increases the likelihood of either a violent correction or a violent squeeze. According to Tom Lee, this is more than just technological difficulties. According to him, Ethereum is poised for a historic bull run propelled by the intersection of demand for artificial intelligence and Wall Street financial flows. According to this theory, Ether is developing from a speculative asset into a vital component of the global infrastructure, possibly surpassing the network value of Bitcoin. In his opinion, despite the upheaval, a paradigm change is taking place in September, one that might reshape Ethereum's role in the banking industry. Let's revisit Tom Lee's most recent sharp market analysis. For more in-depth material, don't forget to like, subscribe, and turn on notifications. We appreciate you being here once more. Watch the remainder of the video.
Right, I became chairman of BitMine on June 30th of 2025, and at that time, the company had announced that there was a $250 million investment being made into the company to help it transform its cash operations into owning Ethereum as a treasury. So it still has an operating business, but now the treasury part is managed or owns Ethereum. And that group of investors was led by Mosaics, which is a hedge fund backed by Stan Druckenmiller, along with Founders Fund. And there were a lot of other large firms that invested as well, including Kraken, Galaxy Digital, DCG, and traditional funds like Diametric Capital, among others. Well, Bitcoin has done very well over any 10-year period, and at $100,000 today, it does reflect that institutions are beginning to view this as a legitimate way to store value, because the Bitcoin blockchain is really one of the best ways to record financial transactions with 100% never failed censorship resistance, never fraudulent entry in its entire operation. So, but institutions, only about 5% actually own any Bitcoin, but 95% of Bitcoin has already been mined. It's a fixed supply. That's a stat from Bitwise. But that 5% that isn't held yet, because the other Bitcoin is basically being hodled, has to be acquired by those 95% of institutions. Plus now governments want to own Bitcoin as a strategic reserve. So if you think about how difficult it is going to be to acquire that last 5%, I can see why it would replace gold or equal the network value of gold, which is over 22 trillion, and that would put Bitcoin at around 1.2 million. It's in the short term, it's probably unclear if it helps or hurts Bitcoin, because Bitcoin also is correlated with global monetary liquidity. Raoul Pal at Real Vision put up this chart years ago that shows M2 versus Bitcoin, and it's been almost dead on at all the bottoms and tops. Once we would be through Fed interference and the Fed is easing, of course, that's good for Bitcoin. But in this period of risk off, I would say it would hurt stocks and Bitcoin.
What is the case for Ethereum then over Bitcoin?
Well, Ethereum differs from Bitcoin. Actually, Ethereum was initially a fork of Bitcoin, by the way, but with an added feature, which is smart contracts. So what they wanted to do on Ethereum was to say, let's use blockchain technology not just to store value, but now to store information. Ethereum is as a smart contract platform, actually also has something called the EVM, Ethereum Virtual Machine. So you can run entire programs and conditional contracts on Ethereum. And Ethereum itself is 100% reliable. It has not had a single moment of downtime since inception. It's one of the few blockchains that has never been down. And then if you needed to do more things on Ethereum, you can build what they call layer 2s on top of it. So Ethereum is essentially infrastructure that now is catching the attention of two industries. The first is the financial sector. The stable coins became really a breakaway product for crypto. And that's like the ChatGPT moment. There's $250 billion worth of stable coins. The vast majority of those are minted on Ethereum. Then the Genius Act was passed by this administration and this Congress, and that greenlighted the proliferation of stablecoins onto the blockchain. So banks are now building stablecoin products. That Treasury Secretary Besant thinks that could get to $4 trillion. That's exponential growth, burning gas on Ethereum. And then we have Project Crypto, which is the SEC wanting Wall Street to build on the blockchain. Now, all of that collectively, from a Wall Street perspective, is like 1971 for the dollar. And what I mean by that is, in 1971, the dollar went off the gold standard. So in 1971, the dollar became synthetic. And gold was what people bought as a hedge against that synthetic dollar. So you had gold as the trade, and that would be the Bitcoin equivalent. But actually, the synthetic dollar is what created the rails for Wall Street to build all their future products. The futures, curves, derivatives were all because the dollar was a synthetic product. If the dollar was backed by gold, Wall Street would be still a very small business. Well, Wall Street now is going to be building its entire infrastructure onto the blockchain.
Lee uses two significant turning points to illustrate his theory. The first is the widespread use of blockchain on Wall Street, similar to how the demise of the gold standard permanently altered finance. He refers to this as the 1971 moment. The dollar did not fall apart when it left gold. It developed into a system that produced futures, derivatives, and whole markets based on confidence in the dollar. Lee thinks Ethereum is currently experiencing a similar situation. Wall Street is constructing its next stage, mainly on the Ethereum blockchain, with an emphasis on stable currency, tokenized assets, and novel settlement methods. This isn't a hypothesis, it is taking place in real time. The way has already been cleared by laws like the Genius Act, and Treasury Secretary Besant predicts that the stable currency market, which is largely based on Ethereum rails, might reach $4 trillion. Artificial intelligence is a second force. According to Lee, AI will require a safe and reliable method of communication and instruction storage as it grows more independent. Ethereum provides the ideal proof mechanism for machines to communicate with one another because of its track record of uptime and support for smart contracts. AI lacks a layer of trust, which might drive value and usage to levels that Bitcoin cannot match. Which coin dominates the world is now the race, not which one is digital gold. To learn more, let's read some excerpts from Lee's interview.
That's right. This is not going to be a popular statement because there's a lot of tribalism in crypto. But before this year, I would have considered Ethereum like a really good, reliable chain, but without any products being built on it, it shouldn't really do well. But because of what's happening with AI and with Wall Street and Project Crypto, I think Ethereum's essentially the value of its protocol layer, like Union Square Ventures calls it the FAT protocol, is now going to be more valuable because we're tokenizing everything on Ethereum rather than just gold. So if gold is a $21 trillion market, tokenizing the real world is orders of magnitude larger than gold, which means Ethereum probably will flip in network value versus Bitcoin. Yes, I understand that. I think that the distinction to make is that I'm not bearish on Bitcoin because I think Bitcoin will get to 1 million. Well, other cryptocurrencies don't have the network value because otherwise they're just software chains. Meaning, that's right. Yeah, I think that the narrative of storing value is really Bitcoin's use case. Ethereum's use case is that it's actually going to be used and burned. So Ethereum gets consumed through gas fees, and then staking is how you produce an Ethereum. That inflation rate has been below Bitcoin, actually. So if you look at it as monetary supply, Bitcoin's monetary supply is actually still growing faster than Ethereum. If I could give a little historical perspective, when Tether created the first dollar stablecoin, and they built it on Ethereum, their idea was someone doesn't always want to be long Bitcoin or another crypto. They want to be long something stable. And crypto holders weren't really allowed banking access. So they didn't have an off-ramp. So Tether built a dollar-backed coin called a stablecoin, USDT. Mm-hmm. In 2017, Google and the UT Austin wrote these papers claiming Tether was just a fraud. And the only reason crypto went up was because of Tether creations. Okay, so in other words, it was immediately tried to be viewed as something fake. But then Tether has since grown, and of course stablecoins have really grown in popularity. Merchants outside the US love stablecoins because they don't suffer the chargebacks. You know, credit card companies merchants eat fraudulent transactions. So merchants, they get paid, it's just as good as getting $1. In Turkey and a place like India, Tether trades at a premium to the dollar because people prefer to get that over cash because it's hard to get robbed. You know, you can use a stable coin to buy real estate in Dubai now using Tether, like $100 million transactions. So it's actually being used in the real world. Actually, stablecoin usage, 80% is outside the U.S. But the reason the U.S. administration starts to like it is, number one, crypto is essentially 100% quoted in dollars. In GDP terms, the dollar is 27% of global economy. Mm-hmm. It's 55% of central bank reserves is the dollar. It's 80% of traditional financial market pair quotes. So the synthetic dollar, which happened in 1971, made the dollar 80% dominant. In the crypto world, the dollar is 100% dominant. So the U.S. wants us to financialize into crypto because everybody prefers to get $1. Collectively, the stablecoin industry is about $280 billion of outstanding dollars. They are now the 12th largest holder of treasuries in the world. Japan owns 1.2 trillion of treasuries. Treasury Secretary Bessent thinks this market will get to 4 trillion. That would make stablecoins the largest holder of treasuries in the world. So it'll be backstopping the entire treasury market soon.
And, you know, we're like the ephemeral market guys. You're having these great conversations. I've been listening to all of them, and really with some like really important market participants and great thinkers in and around the market. So we've enjoyed listening to your podcast. Our podcast, Risk Reversal Podcast, drops 5 days a week. It's Guy and myself having just kind of conversations with folks that are very relevant about the markets. And, you know, oftentimes we're talking about what happened yesterday, what's happening today, what might happen tomorrow. We have, you know, guests from strategists, investors, analysts, and the like here. So for us, it's been really fun. We scratch an itch that we don't always get to do on CNBC's Fast Money. There's a lot of sound bites, and that's a lot of fun for us. But this is a different medium, and we've enjoyed it. And Guy, you and I, we got good chemistry here, don't we? And we enjoy.
Lee now clarifies that he is not abandoning Bitcoin and cautions against misinterpreting his position. He reiterated his long-held forecast that Bitcoin will eventually hit $1 million if institutions continue to pour money into it, stating that he still thinks it has a huge potential. In a society where debt and money printing are commonplace, its fixed supply gains even more value. But he also makes a distinction between Ethereum and Bitcoin that emphasizes how different their functions are from one another. Bitcoin is the ultimate vault for digital gold, allowing users to safely deposit and safeguard their money. But Ethereum has a different approach. It is used, not merely stored. All network operations, including payments, smart contracts, and tokenized security, use fuel. Lee cites this ongoing gas burning as Ethereum's distinguishing strength since demand increases with activity. And activity is precisely what the financial and technological future is based on. For this reason, Lee thinks Ethereum may eventually surpass Bitcoin in terms of network value. He contends that artificial intelligence systems would start to rely on Ethereum to validate and secure its commands if Wall Street proceeds with its intentions to tokenize trillions of dollars worth of assets, including stocks, bonds, and real estate. In that scenario, Ethereum will see demand pressure that has never been experienced before. It would not only rival but even surpass Bitcoin's buy-and-hold strategy. This shift could become more significant than the gold market since it involves daily creation of new value in addition to value storage. Bitcoin will remain the best way to protect your wealth. Nevertheless, Ethereum is positioned to be the catalyst for the development of financial goods, AI-driven economies, and the future's digital infrastructure. Choosing a side in this dispute is not important to investors. Their respective jobs are becoming increasingly important every day. Bitcoin continues to be a hedge and a rare digital asset that appeals to people who wish to be protected from the failings of governments and central banks. Ethereum, however, is evolving to the point where its network is traversed by each new wave of technological and financial advancement. That type of value, which is connected to necessity and use, is distinct. Furthermore, Tom Lee is not implying that Bitcoin will suddenly become obsolete or that its significance would diminish. He is making the point that even the most ardent Bitcoin supporters might be surprised by how the market eventually acknowledges and rewards Ethereum's greater utility. For years, people believed that Bitcoin was stuck at the top of the crypto hierarchy, which was incapable. Lee contends that this presumption may be verified. Nevertheless, Ethereum won't just be another potent digital asset that sits next to Bitcoin if his vision comes to pass. It will develop into a much larger systems engine room. That system might encompass networks where AI robots converse and validate their behaviors, as well as Wall Street trading floors where trillions of dollars worth of assets are tokenized. According to him, the true question is not which coin is the safest to carry, but rather which one is essential to the modern world. Thank you for viewing. Remember to subscribe and like.